Hi, everybody, and welcome back to video number 7 in Chapter 20. And when we left off, we were looking at special lease accounting problems, and the first one is residual value. From a lessee perspective, a guaranteed residual value. The guidelines for accounting for a guaranteed residual value are if it is probable that the expected residual value is 1, equal to or greater than the guaranteed residual value, the lessee should not include the guaranteed residual value in the computation of the lease liability. And number 2, if it's less than the guaranteed residual value, the difference between the expected and guaranteed residual value should be included in the computation of the lease liability. Okay, to illustrate a situation where the expected residual value is below the guaranteed residual value, we will assume in the earlier coffee and beans / Starbucks example that it is probable that the residual value will be $3,000 instead of the guaranteed amount of $5,000. So, if Starbucks estimates the residual value of the bean roaster at the end of the lease to be $3,000, Starbucks includes $2,000, that's $5,000 here, less the $3,000 residual value as an additional lease payment in determining the lease liability and right of use asset. So, the following illustration is going to show the computation of the lease liability, right of use asset for Starbucks in this situation. Okay, so the present value of 5 annual rental payments, that's going to be the $20,711.11 times the present value factor. And that comes out $95,890.35. Now, the present value of the probable residual value payment due 5 years after the date of commencement is going to be that $2,000 times the present value at 5 years and 4%. And that is $1,643.86. And if we add the two together, we get the lessee's lease liability / right of use asset at $97,534.21. So if we look at the lease amortization schedule under the guaranteed residual value here, under an annuity due basis, we see that it's going to be $97,534.21 on January 1, 2025. So we record that here as a debit to right of use asset and a credit to lease liability. But we also include a reduction of lease liability shown here at $20,711.11 to lease liability debit and a credit to cash for that same amount. Okay, for Starbucks, we're going to show the $97,534.21. And as you can see, we amortize that lease liability down to 0 over the life of that lease, as shown. Okay. So if I look at Starbucks entries for the first 2 years of the lease, when Starbucks expects to pay $2,000 at the end of the lease, and when Starbucks does not expect to owe an additional payment. So I think you can see that here we're going to expect the $2,000 payment here in these columns, and no expected payment in these columns. So as you can see, the first year we do that entry, but then we do an adjusted entry at the end of 2025 where we debit interest expense and credit lease liability for $3,072.92. And if I go back here, you can see that computation here for the interest expense. All right. And then in the second year, it's going to be $19,506.84, debiting to amortization expense and a credit to right of use asset. And we get that by taking the $97,534.21 and dividing it by 5 years. And then again, we have our lease liability of $20,711.11 and a credit to cash for that same amount. I won't go through this column. All we do differently is the way that we calculate the present value of those payments. Okay, now at the end of the lease term, that's going to be January 1, 2030, Starbucks returns the asset to Coffee and Beans and makes the following entry under two situations. Here, we're going to debit lease liability for $2,000 and credit cash. And if there's no expected payment for guaranteed residual value, we won't have any entry. So if I assume Starbucks and Coffee and Beans agree that the fair value of the asset is sufficiently below the expected fair value, such that Starbucks must pay an additional $1,000 upon returning the backhoe to Coffee and Beans on January 1, 2030. In this case, Starbucks will make this entry. We will debit lease liability and debit loss on lease, residual value guarantee for $1,000, and credit cash for $3,000. Okay, now an unguaranteed residual value. Here, a lessee does not include an unguaranteed residual value in the computation of the lease liability, whether it is a finance lease or an operating lease. At the end of the lease, the lessee simply returns the leased asset to the lessor without any other payment. In the Miso McDonald's example presented earlier, that illustrates that the lessee accounting for an unguaranteed residual value. Okay, so back to the lessor now in a guaranteed residual value scenario. In the Starbucks / Coffee and Beans example, also presented earlier, Starbucks guaranteed a residual value of $5,000. In computing the amount to be recovered from the rental payments, the present value of the residual value was subtracted from the fair value of the bean roaster to arrive at the amount to be recovered by the lessor. The following illustration shows that computation. So here is the amount to be recovered by the lessor through lease payments. And we calculated that earlier, so I won't go through it again. And then we are going to take 5 beginning of the year lease payments and divide that $95,890.35 by the present value factor for 5 years and 4%. And that comes out $20,711.11. Same calculation as before. That computation is the same, whether the residual value is guaranteed or unguaranteed. So, if in this case there is less certainty that the unguaranteed residual portion of the asset has been sold. So 1, the lessor recognizes sales revenue and cost of goods sold only for the portion of the asset for which recovery is assured. 2, both sales revenue and cost of goods sold are reduced by the present value of the unguaranteed residual value. And 3, the gross profit computed will still be the same amount as when a guaranteed residual value exists. Okay, in a sales type lease with a guaranteed residual value, here, to compare a sales type lease with a guaranteed residual value to one with an unguaranteed residual value, we will assume the same facts as in the coffee and the beans / Starbucks lease situation presented earlier. So that is, in review here, number 1, the sales price is $100,000. Number 2, the expected residual value is $5,000 with a present value of $4,109.65. And 3, here, the leased equipment has an $85,000 cost to the dealer, coffee and beans. Okay, so if I look at the computation of the lease amounts by coffee and beans in a financial sales type lease, here they're showing the guaranteed residual value, and we go through that calculation here that we just went through. And then the sales price of the asset is $100,000. The cost of goods sold, $85,000. And the gross profit, of course, will be $15,000. But in a unguaranteed residual value, the lease receivable will be the same, but the sales price of the asset will be $95,890.35. The cost of goods sold will be $80,890.35. And the gross profit will still be $15,000. Okay. So the entries for the guaranteed and unguaranteed residual values in a sales type lease. Here's our guaranteed residual values here and unguaranteed residual values there. Here we have our standard entries for cost of goods sold and inventory and sales revenue and lease receivable. Pretty straightforward there. And the same structure except the adjusted for unguaranteed amounts from the previous slide. Our cash and lease receivables at $20,711.11 are the same under both scenarios here. And our lease receivable and interest revenue are the same as in both scenarios. And then the receipt of the second lease payment is going to be the same here. And the interest revenue will be the same here. And then as we record the final residual value at $3,000, our inventory will increase by $3,000, cash will increase by $2,000, and the lease receivable will be $5,000 in both the guaranteed residual value and the unguaranteed residual value scenarios. Okay. Now, if I summarize the treatment of these residual values, here, if I have from the lessee's perspective, I have guaranteed residual value. We're going to include the full amount of the residual value in present value. And we're going to ignore that in the unguaranteed. In the guaranteed residual value scenario, if the expected value of the residual value is greater than or equal to the guaranteed residual value, we'll ignore that. And if the measurement of the liability, if the expected value of the residual value is smaller than the guaranteed residual value, then we'll include that present value of the difference between the expected and guaranteed residual value in the computation of the lease liability. And we'll ignore that under the unguaranteed residual value. That looks like a good place to stop this video, and when we return, we'll take a look at the lessor's perspective.